My name is Daryl Martin. I'm from apexinvesting.com. I'm a trader. I've been trading for over 10 years. I trade futures. I trade Forex. I trade some options. I trade even some Nadex spreads and binaries as well. And we have about 7,000 members at Apex. And just keeps growing, and mostly almost all referral based. We don't really do any big advertising besides doing some just joint webinars. That's about it. Before we start any kind of webinar, I always throw up the standard risk disclosures. All trading involves risk. Know what you do before you're doing it. Basically take responsibility for your own trades. At the same time, just make sure you get the proper education. This is the bottom line. And this is unique information presented by apexinvesting.com. And just another fun risk disclosure, but we risk disclose everything. All right. So, like I said, I'm a trader. I'm also an educational partner with the North American Derivative Exchange. I'm an educational partner with Ninja Trader, and work with, like I said, just a lot of traders all over the country. Our sites, keeps growing. It's pretty amazing. We're getting about 100, 150 new members a week coming in. And I host a radio show every single day called the Diagnostic Trading Hour. And that's actually broadcast in multiple places, but also we just broadcast it right in our site for you where you can listen to it or even see it if you want to see my screen while I'm talking. And I put on 3 trades today on NASDAQ, and all 3 of those were profitable, so that's pretty cool. And while I was on the show. And then I also do another show on Friday mornings called the Bull Bear Binary Hour with Tommy O'Brien. The big thing is I developed a pattern that I learned from other traders, other hedge fund traders, pit traders, guys that move the markets around, and they taught me a few things and also a few tools along the way. So that's enough about me. Let's talk about the markets. Professional traders. People are always trying to figure out, what is a professional trader? Somebody who trades to make money for a living, right? And the big difference in a professional trader versus a trader who's just trying to make it a hobby is they see the market differently. They have a supplier versus a consumer mentality. And they go in and they go, where is the market going to go? And instead of going, okay, well, when it gets here, I'm going to buy because I think it's going to go up. All right, when it gets here, I'm going to sell because I think it's going to go down. They go, where would everybody be thinking when it gets here, I'm going to get in? Because that's where all the orders are going to be. After that, it's like a 50-50 crapshoot. So if all the orders are going to come together at those resistance levels, the support levels, those Fibonacci levels, and whatever other master level you want to come up with, if they're going to come together at those points, and if you're going to make trades based on that, you and everybody else, why not be the person that supplies the other side of the contracts? So if I think it's going to go, when it gets up to this point, I'm going to do a bounce. I'm going to do a swing trade off of it. And almost always I'm right. It gets up there. But how often are you right after it gets up there when it does? And that's sort of the point, is they don't go, when it gets there, this is what I'm going to do. They go, it's going to get there, and so therefore what I'm going to do is I'm going to act now and take advantage of it. And that's really what you want to learn how to do as a trader, is take one thing, get one step ahead in your thought process. You want to filter out the noise. We're going to talk about that a little bit more, but a lot of people are still using time-based bars for a majority of their trading. I use time-based bars for certain things, very small ones. But if I want to catch trends, like big trends, I don't use time-based bars. It doesn't make sense to me. I'm going to have another bar on my chart to analyze the potential of a trend just because the Earth moved a few degrees. Because that's what it is, right? Time is just the Earth rotating. And so, therefore, since the Earth rotated a few degrees, I get another 5-minute bar. And I'm all about 5-minute bars for certain things, but not for big trends. If you want to catch the trends, or the trend reversals, you're going to have to filter out the noise and stop thinking about the Earth rotating and start thinking about what price action is taking place using unique tick size bars. I'll show you our bars here in a second. You also, and this is probably the biggest, from what I've seen over the years, this is probably the biggest missing component that a trader has in their trading, is they do not have proper expectations of market movement. In other words, they get in, they have no idea how far the market's going to move. They see it going up, and they're hoping it goes forever. And maybe they're adding on to trades, and they find themselves buying at the top of markets. They find themselves selling at the bottom of the market. They have no proper expectation on movement. And we actually have expectations by, I mean, you can look at it by 30 minutes, hour, day. We get like right down to the expectations, and we know it day after day after day. And it's just one of the things that you have to have those proper expectations in place to know when to trail your stops, to know when to not add on to or not enter into a position, to know when to look for a potential bounce. And it makes a world of difference. And where do we get proper expectations from? The best place to get proper expectations from is actually, there's two areas. One of those is implied volatility, which is the expected movement built into an options price. I'm not talking about if you're trading options, but what we do is we pull out that expected movement built into the price of an option, and then we factor it into a deviation formula, sort of like a standard deviation bell curve. The problem with the standard deviation bell curve is it looks at past movement to project forward movement. And I mean, we all know the disclosure. Past performance is not indicative of future performance. So why would a standard deviation be indicative? Okay? But what is very indicative of future performance, not necessarily on whether you win or lose, but on direction and distance, especially on distance, is going to be implied volatility. Because what implied volatility is, how much are all the market participants willing to pay for an option? And that really comes down to how far they think it's going to move. And so it's people putting their money where their mouth is. It's the ultimate market survey on how far the market's going to move. And so we automatically calculate that on all the markets. And we have our implied deviations, we have our average deviations, so that way you can cover any market that exists. And like I said, just day after day, I mean, here's NASDAQ, and we're basically saying, okay, it goes down, it'll probably hit one deviation. That's what it hits basically 7 out of 10 days. If it does break through that with any kind of significant volume, it'll probably come on down to 1.5 deviations. And you can see that's right where it hit. That's today's chart. And, you may think it's going to have a big bounce back up, but maybe not. But it definitely came down to this area. We kind of bounced right off of it. Would have knocked most people out on their stop loss, right? Came back down. Yeah, I got one last push there right at the end of the day, but it did it with volume. I remember I said there's two things. The first thing I said was implied volatility. The next thing is volume, expected volume. We're going to talk more about this as we go. But on expected volume, this is expected volume right here. We got blue, which is actual volume. This is just your normal, everyday volume. Okay? But this yellow line is key. Okay, this is the expected volume for that time of the day, for that day of the week, specifically how much we expect volume to be. If volume is more than that, then we expect it to be a larger trending day. If it's less than that, we expect it to be a very slow day. And we add on to it expected movement by hour. So if I go over here and I add on expected range, then I can actually get the expected movement by hour. And this is automatically plotted. It's actually plotted an hour in advance. So the next hour is already being calculated. As you can see right here, it's really small for the next hour, obviously. Just the time of day it is. But you can notice this is a really good example of a day too. It ran right up. Right there was the expectation. So if it moves up, this is how far it'll move up. If it moves down, this is how it will move down. And we calculate one other thing with it that helps out a lot. You'll see this expected range high to low. And what this does is, instead of just calculating, I'll grab this one. There we go. Instead of just calculating from the open of the hour to the close of the hour and how far it would move up or down, what about if it moves up, part of that distance and down part of that distance? So what we're doing right here is we said, hey, the market should move 19 points, during this given hour. And obviously it well exceeded those 19 points. Or basically it hit those 19 points. We got 19.25, we got to 18.25. Not bad, 1 point off of the expectation. But what if it went down like 10 points and then went up 19 points from there, so it was only in the middle? Well, that's what the expected high to low does. So as you can see, we're pretty much right on track with volume. See how it even says volume should be dropping. It is dropping. That's nothing normal for that time of day. And then we say, hey, it's going to sort of level off. It does level off. And then it starts coming down, and we hit the expected move on this hour. But notice what happens. Notice how volume, which normally is sort of flat to negative, is exceeding expectations. Okay, so as soon as you see that volume start breaking out, hey, the market's probably going to keep going. It does it. pops on down, moves on down. Now it goes flat. We notice like there's a massive volume spike on an up close bar right there. So you have one of the highest volume bars, actually the highest volume bar of the day. Massive take profit. They're really holding it. Look at where they did that at. Right at one deviation. We got 38.88.25, and what do we like a tick off of that? See, low is 38.87.5. So like, yeah, 3 ticks, not even 1 point off. Right there, a ton of volume comes in. Statistically, okay, remember this is be one step ahead by thinking like a supplier versus a consumer. So the professional, the larger traders that force this market down, they had an expectation that the market would move this far based on implied volatility, expected movement. I learned this formula from a floor trader. And then I decided to put it together a little bit different way that he used it, but it's how he used to know when he was going to hedge off certain positions. I use it to know how far the market's going to move. And so as it's moving down here, I mean, right down to the expectation, all of the closing orders come in. That's that buy order. Pops it right back up. Market's pretty much cooked and done for the day. When that happens, right around 11 o'clock, and you see a massive volume spike, especially if it's bigger, that is really most of your expected move. Today was a little bit unique because we had Google earnings coming out, but the market sort of flattened on out. And obviously, you should probably expect another nice move if you're going to have Google earnings coming out on the NASDAQ. And so basically, it pops right up here to a 0.5 deviation, like exactly to it. And we're staying right within that expected move after that hour. Notice how we get that pop, but then it dies off on volume. We stay within the expected move again. We're staying inside of it, expected move again. We're staying inside of it. Comes down here, volume really picks up at the end of the day. Just knowing fundamentally, hey, you know what, Google's coming out. Earnings are going to start, causing some volume to happen. And if you're watching Google at the same time, which I was, you're going to see all this big movement happening. Boom, it breaks out. But is it a surprise it broke out? No, look at all the expected volume. A lot more expected volume. Then it turns around and flips back the other direction. And lands right on 1.5, which is one deviation down from 0.5. And again, I normally wouldn't expect it to even go 1.5. Just today we had the earnings. But it's learning to use things like simple expected movement and expected volume so you have proper expectations so you can know where the market's going to go on any given hour. If I get a sell signal, right here, do I really want to take it if I don't see a lot of volume coming in the market? Probably not, because it's probably going to oscillate around on me. So I really like it when I get a sell signal like right at the top of the hour somewhere over here and I'm somewhere in the middle of a range. That's a great one because I know, hey, I got some expected movement during this hour, but I think this hour's cooked, and so I'm going to get in. You get in, things cross over, and then all of a sudden you just watch this thing chop. It's driving you nuts. So a lot of times you get out of the trade because you're like, oh, it's just not going anywhere. You're probably right because it's at one deviation, and then all of a sudden just pop, it drops down. So whereas if you got a sell signal right here with this volume coming in, all of a sudden increasing, okay, now it's time to get in. We have a lot more volume than expected, and then pop, it goes right down and you get a quick move. Now that's not the signal system I'm teaching you about. That's just helping you understand how the markets work. So again, see the market differently. Also filter out the noise. We haven't even went into that yet. And have proper expectations of market movement. Trading's not as easy as we want it to be. And, I think that's a reality, right? We all want it to be super, super easy. But it's also not as hard as most people think it is. It's just people are looking at the wrong thing. They're looking at 1,000 indicators. And, some people look at my chart and they're like, oh, that looks so messy. And it's like, well, not really. I got some levels, deviation levels. And this whole, green thing down here, green and red, I'm measuring high to low on a deviation move. So what if it moves up 0.5 and down 0.5? Okay? So these are really just the same thing. This is just telling me from settlement, and this is telling me from high to low. Then I got these little boxes right here, expected move on an hour. This is telling me from the open of the hour. This is telling me from high to low. And then right here, I just have expected volume and actual volume. That's all I got on the chart. There's not a whole lot on there. There's some other things I could teach you about as well, but just to keep it simple. As a trader, to be a successful professional trader, what are some of the things that you're going to have to do? You're going to have to use a system. And there's strategies. Strategies are like how to use an instrument. Okay? A strangle is a strategy. But when to use a strangle, that's a system. It had to be very system-based, meaning very ABC-based. Okay, now you need to be able to read the market, and that's the things like deviation levels and volume. That's your 1, 2, 3s that you got to learn. But you also need to have an underlying basic system that tells you exactly when you get in, exactly where you put your stop, and exactly how you're going to trail your stop. If you don't have that predefined, you're going to be trading by gut, and you're going to wonder why, man, sometimes I just nail it, and other times I just get destroyed, and you just don't know. There's no consistency because you don't have a consistent system for defining to the tick your exact entry, your exact stop loss, your exact trailing stop. And if you don't have that consistency, if you don't have that defined system, then there will be a lot of opportunities for you. But if you don't, you're going to have doubt. You're not going to have the confidence to execute because it's hit and miss. I mean, you're just sort of swinging by the gut. Well, that looks like sort of that's crossed that. It looks like it broke above it a little bit. I think I'll go ahead and buy that one. Yeah, you're just like shooting from the hip. And, you know, you don't want to build something on some magical indicator. Okay? I mean, what we're using isn't really, it's not rocket science. I mean, I'm not saying it's simple, but it's not, I mean, it's simple to use. But, I mean, there's, like, I'm very transparent. I explain to you what it is. I explain to you how it works. I explain to you the market theory behind it. I won't put something on my chart unless I can understand why it should work. Because just because it does work doesn't mean it will work in the future if there's not any market theory movement reason behind it. Just, hey, when I put these two lines and they cross, man, it makes money. Yeah, that's nice if that worked on your optimized setting for the last 6 months, but I'm talking about what should I look at going forward? Why would I trust my money in whatever I am doing? And so you want to understand the why. Well, if the market's driven by orders, okay, and if there are expectations built in the market based on option pricing, that's how far the market says the market's going to move. The market's going to go to where the orders are located, and it should stay within these expected ranges. And the only time it should go out of those ranges is when there's more orders than normal volume. Exceeding that, then that's when I could expect it to actually go outside that range. So it's how the market works. It's a market is made to fill orders. And as I've worked over the years with me and a bunch of other traders, we have what's called the Apex Alliance. It's just a bunch of members that have been Apex members for a long time, and they all contribute. We all brainstorm. And we're very big on don't follow the guru, become the guru. You know, it's not like, hey, come into my room and just do what I say. I want to empower you. You know, I'm not into spoon feeding. I don't think that helps you. I think that's a good way to drive over a cliff with somebody else, like a lemming. I want to empower you to know how to read the markets, know why the signal's there, know how you're going to take it, know what you're going to do, know if you shouldn't. You know, empower you. And so as you do that, you need a system that does a couple things. It needs to have a goal of limiting your losses and letting your profits run when you're doing trend trading. And you need a price action driven method to define your steps. Obviously, we already talked about you also need proper expectations of movement and volume with that too. These steps that you have, these defined steps, have to account not only for how the market moves, so they have to have a reason behind them, not just two lines crossed, but they also have to account for you. Because you are the biggest. I just did 2 big webinars, about an hour and a half, 2 hours the last couple of weeks, just on trader psychology. And the hardest thing to overcome, because you could have the perfect system, meaning, you know, it wins more often than it loses, and it makes more when it wins than it loses. That's the perfect system. The perfect system is not never loses. As much as we'd all like that to happen, perfect system is good risk management and decent probability, combining those two things together. But no matter how good that is, you know, I see traders every day. Oh, man, I missed that when I just hesitated. Right? So it's like, okay, you can't hesitate. You got to know your rules. You got to know your why. What caused you to hesitate? Were you risking too much money? You know, what's happening in your psychology? Because your psychology, even with the best system, will mess up any system. Then people go, well, I just want a robot to do it for me because I'm just not disciplined enough. Well, that's not an excuse. Trading does unveil definitely our weaknesses. And so a robot's not going to help you. Because a robot can account for the ABC, the absolute, when this happens, then do this rule. But it can't account for, hey, by the way, Google's coming out today. You know, so Fed funds is about to be released. What time of day is it? I mean, there's so many things. I mean, I guess eventually could be programmed on, you know, millions of lines of code. But you can get down about 90% of it on the system. But that 10% style, that trading psychology, that reading it, it all still, no matter what it is, because if you go in and you put it all in on one trade, it's going to blow up because you need to make money, or you were just that confident it was going to happen, or you're double downing because you're revenge trading, or you're just trading with too little money in your account, and so you just got to risk 30% per trade. You can only take the first trade. If it wins or it loses, well, if it wins, you're in. If it loses, you're out for the day. You have absolutely no probabilities working in your favor. There's so many things that go into trading psychology. And one of those things that I've learned when I develop a system is I really have to know what I'm going to do and why I'm doing it, or I won't follow it. So when you make a system, don't just look for what works, which that's great, but look for what works that you will work. Like, will you work it? Will you follow the plan? And as you develop a system, you need that. One thing I tell you is I've learned that you do not need 20 patterns. You don't need 200 patterns on charts or candles. I've sat down with one of my mentors. We sat and we literally did this major study over 10 years on all the candlestick patterns, and we found a 51% edge, meaning there was basically a 1% edge, and after fees and spread, you wouldn't have come out ahead. There was no advantage to going in and just doing like adding in all these different 10,000 chart patterns. What I found from the big boys, the market movers that I've sat down with and I've watched them say, okay, I'm going to make Microsoft go here, then here, then here, then here, then here, and I watched them do it over 2 hours. That the market simply moves to fill orders, and I can pretty much get every pattern that you can come up with, and we can tie it into one simple pattern. And it captures this fact time and time again that what moves the market is simply orders. That's it. Nothing else. I talked about removing time-based bars from the equation for trend trading. Time-based bars are completely illogical. Like I said, the earth turns and you have a new bar on your chart. What does that have to do with the market? Nothing. They're choppy. Think about, you get this chop and all of a sudden all your indicators are just chopped up. So there's just a lot of mess that you have to deal with whenever you're trying to do a time-based bar chart. And so what I try to recommend people do is learn how to look at tick-based bars. And there's different kinds of tick-based bars. But what you want is something that's really clean, that unless the market moves, you don't get a new bar. Okay? Has anybody used a tick-based bar that's on this webinar today? See if we got any participants in here. All right, there we go. Patience, that's a good name. Yeah, they're very helpful if you use the right kind. There's all sorts of them. There's some weird ones. There's some that they're phantom bars. They don't pay real things. There's some that don't accurately record volume, and you need volume. Volume is one of the 3 essential components of trading: proper expectations of movement, proper expectations of volume, and price action. So you need those 3 components in any trading system that you use. So one of them says, hey, I've used range bars. I've used some Renko bars. Exactly. Those are tick-based type bars. So that's good. We'll get into that in a second. I'll actually show you some of our bar stuff here. So let's get into some of the methods we show you: how to limit losses, how to let profits run, and go into the Elite MVP entry system. So one of the ways that we trade. These are actually charts from our trade room. And I know it's sort of tiny because we're trying to push it all in there. But this is like a Monday, Tuesday, Wednesday, Thursday, and what we're doing is we're simply looking to try to keep it as simple as I can for you. We're looking for an E. Okay, so we get an E right here. E bar, entry. Okay, so we got alert for A, P for pivot, E for entry, and X for confirmation. That's the pattern, apex pattern. Okay? They drive it down, they do a quick pullback to get a little bit more action in, get some other people in the market, and then push it on back down. Okay, until we get to like a 1 deviation level, then we're going to look to stop adding on to a position. So like right here, the trader sees the E, and when it breaks that E by 3 ticks, so 3 ticks below the E is low on a short, or 3 ticks above the E is high on a long, then we'll go short. And as a confirmation, there's this red and green line. You see this little red and green trend line that we made? We call that the MVP. It's the momentum volatility predictor. And what it does, it helps us not only confirm a trend, but it also allows us to go in and filter out a ton of chop. Because one of the biggest battles I face as a trader, or I had faced as a trader, was how to get rid of the chop, like a day like this. And so the market's moving down, we take it, and we trail that on down, and this closes out, in a day, trade's closed out. It would have kept going, actually, but closed out. So if we get in 3 ticks below the E, we set our stop 5 ticks above the P. So very defined. I know exactly where I'm getting in. I know exactly where my stop loss is. Then I'm going to trail my stop with this MVP line. And I'll just keep trailing it and trailing it. That was about a $550 trade right there. I'm going down, new morning, another E. Awesome. Because I got flat, I didn't want to hold overnight, didn't want to pay the margin, wanted to sleep well, etc. And so got in again, 3 ticks below the E, stopped 5 ticks above the P, trailed with the MVP line, and boom, out of the trade. So made another $300 on that. That trade was a $300 profit trade. And then we got an MVP reversal trade. This is after you have a big long trend. Often we'll see a big pop and reversal. So this has an MVP reversal on it. It wasn't massive. It was like a $50 trade. Basically, after it went up, it sort of just oscillated around. But here's the biggest key I want you to see on this day. Not only did we come out with a little bit of profit, we got a few $100 in the morning and about $50 there in the afternoon. The biggest thing I want you to see is right here. See these little triangle E's? I mean, now, this is being drawn on the chart. So like Steven, one of our traders, we have several traders that are doing oil and Russell and, various markets and pound yen. And so we have various traders in the room that will post their charts. We can post as many traders' charts as we want to live inside of our room. And you can look at whichever ones you want to. All of them or a few of them or one of them or none of them. But anyway, so they're going in there. They're sort of volunteering and sort of posting their chart because everybody's trading the exact same method. It's not really follow the guru. It's just a coaching tool to help you out. And if we get a red E with a green line, that means, hey, chop, don't take the trade. Okay? Well, if we would have got in there, we would have had a losing trade. If we had in this trade, we would have had a losing trade. Look how it came down and popped right back up. Okay? So it helps filter out a whole lot of trades. And then right here, there was a trade right at the end of the day, but it's after one deviation move. So again, we don't take trades right at a one deviation move because we expect the market to be done to stop. And that's a one deviation high to low move there. You can see like right down here, we got that deviation high to low, and you can see that blue line touching there, showing us that it's moved that level. But that just gives you an idea on some of the trades. And we go in. Here's another day. I mean, these are all current. We got a trade in right here. It's an MVP reversal. Made 47 ticks on that one, so that's $470. Here's the next day. That's Thursday. Guess we didn't trade. Yeah, Friday was July 4th, so we didn't trade. Then we got Monday, July 7th. Market's heading down. Have a nice trade right there, like $950. Go in on Tuesday. Trade flies down, $112. I mean, I'm not gonna tell you every day's like this. I mean, there are days right here, no trades. And well, what do you mean no trades? Now there are trades. Okay, we'll get into that in a second. But there's no trend trades. There's no trend reversal trades because there's no trend. And the system. Remember, we can't get in. See all these triangles? We can't get in because the MVP is red and the E's were green at that point. They turned orange after they basically didn't work out. But we didn't take the trade because we don't take a green E when there's a red line. We don't take a red E when there's a red line. It's pretty simple. And this is an FOMC day on top of that. Okay? So, like I said, one of the biggest challenges traders face is filtering out chop. Capturing trends, letting their profits run, but also not giving it all back in chop. And I was really happy when we added this MVP indicator. It was one of the old indicators I used to have, and we started combining it with 3 other things, like 3 or 4 things together. And I didn't want to trade. I don't like trading off of indicators. But to use the indicator as a means for a trailing stop, to use it as a trend confirmation or chop confirmation, that I can live with. I don't want to use it for like my entry definition. All indicators are too slow. I want to use price action for my entry definition. I want to use expected movements to know when to enter or not enter. I want to be able to use volume to be able to confirm a move. But indicators are really good for saying, hey, the market's not doing what it should be doing today. Just back off. And it did a great job that day. And here's another day. This is just one of many charts that we have right here. You go in, and you can see, just to go over the rules with you. If you feel like this is complex, I want you to see how easy this really is, because people make it so hard, and it's not. We have several letters, an A, a P, an E, and an X. Okay? If they're red, that means go short. If they're green, that means go long. Got it? If the red line is red, and the letters are red, check. If the green line, if the letters are green, and the line is green, check. You can buy. Okay? So let's just go with the short again. If you got a red E with a red line, and the next 3 bars actually, breaks 3 ticks below that E. If one of the next 3 bars, if it doesn't do it in the next 3, then there's no trade. Then the next 3 bars breaks 3 ticks below the E, you get in. If it doesn't, just cancel the trade and wait for the next E. If you get in, set your stop 5 ticks above the P bar, the high of the P bar, and then just trail it down with the MVP line. That's it. Okay? Now, I do teach a couple additional things with it, like, hey, when you get to this one deviation level, you might just want to go ahead and take profit or tighten up to what we call a predictor. It's these little arrows. You can tighten that thing up if you want to, but that is the system. That's it. And that's what we do each and every day. That's why I'm like, you don't need to follow a guru. You don't need somebody calling out trades for you. Yeah, we do have trades. We do have them called out. We do have them posted. And sometimes we have a lot of trades. Sometimes we just have a couple trades. But you can watch whatever markets you want. I don't care if you're trading Google or if you're trading 6E or if you're trading gold or you're trading the S&P or whatever it is you're trading. Now, I'll give you my input on what I think about certain markets because of the way they move. Maybe they have too much volume. Maybe they tick too poorly. If you want to catch moves, maybe you're trading the wrong market. Maybe it's the time of day. So I'll give you my input on, the different markets that you want to trade. I'm in the elite room and people ask questions, and other Alliance mentor members will also answer questions for you. But, it's really that simple. Here's another day, a long day on the Russell. I'm just trying to go through a bunch of different days here for you. This is earlier in the week. I showed you like 7374. There's 7172. Here's 711 right there. So last Thursday, that was my mother's birthday. Or was that Friday? That was last Friday, yeah. Flying on down there. And, enter on the P, the E right there, set your stop, trail it, enter again, and you can keep adding on until you get to that one deviation level. Unless, remember, when do we think it's going to go beyond a deviation? Volumes exceeding expectations. Keeps exceeding, you could add on to a position. Okay? I tell most traders to begin with, don't try to play past the deviations until you really get good at reading the volume, just because you'll probably end up buying at the high of the market. Here's oil. Early morning trade. This is today, so 7:17. And we do have a trader, Marilyn. She helps lead the oil trading in the room. And but right there, early entry, flies on up. Another entry right here, flies on up. Nice profit on that trade. So lots of good movement happening each day. And I teach people to learn to watch multiple markets. One of our traders wanted to see, hey, if I didn't even pay attention to deviation levels and volume and all that stuff you're talking about, and I just went through, and I just did, and this is not me, okay, this is another trader, did this back test, and he did it from January 2nd to June 19th. He posted this in the forum, okay, and Brad did this, and he goes in, and he goes, if I just did the Russell, and I just did your Apex MVP entries, your add-ons and your reversals, and we teach you BMX reversals, we teach you momentum scalps, we teach you profit poppers. I teach you systems that work in all market conditions. So you can trade swing markets, chop markets, trending markets, scalping markets, all in the exact same chart. But he's like, if I just did your basic, Apex pattern entries, add-ons, and reversals without using deviations as a factor, what would it come out to? And he went through and he did all the trades for the 6 months, trading between 8:30 a.m. and 15:30 Eastern time. That's the hours that he likes to trade. So he put those hours up there, and he made $18,560 on that. His largest profit was $5,000. His largest loss was $2,000. His largest, let's see, okay, that'd be actually his largest loss. It wasn't daily loss. It was all trades included. So yeah, that's his largest drawdown was $2,000, and his largest total daily profit was $5,000. His largest individual profit that he made on a trade was $2,000. His largest individual trade that he lost was $560. So the most he's lost on a single trade was $560. The most he lost on a single day there was $2,000. The most he made on a single trade was $2,360, and the most he made on a single day was $5,030. So that's, that lines up, right? Anyways, but that's 6 months. Not too shabby for 6 months, and that's trading one contract. Okay? So that's not going in and just, throwing a ton of money in the market. That's a single contract on the Russell. And that's using our 14-tick diagnostic bars with the Apex MVP, add-ons, and MVP reversals. And you saw a bunch of Russell trades we just showed you up there. Now, what are these reversal trades? Basically, what we're looking for on a MVP reversal, and I'm giving you a high-level overview. I don't expect you to, miss all this. Or I don't expect you to get all this. We're gonna have a webinar today, by the way, at 7. If you want to get started and you want to sort of get a little bit more in-depth training. But MVP reversals right here. You got APEX, APEX. Okay. So if you have two Apex patterns in a row, where the second P is lower than the first P. The high of the second P is lower than the high of the first P on a short apex. So basically you have a trend. You're making lower highs. Simple enough, right? So if you have two apexes in a row where the high of the P is lower, or the second P is lower than the high of the second P, you're making lower highs. And then you get a MVP reversal, which you'll see an arrow pop up. The MVP will change direction, the arrow pop up. That's an entry if the next bar breaks its high by 3 ticks. That's it. That simple. Two apex, basically, show me a trend. Think about it. It's a trend. Reversal. I need a trend. I don't want like an MVP that's going sideways. Okay, I want a trend. So if it's been trending, and it's a clean trend where the MVP line is staying red the entire time, ideally, and then pop, it goes the other way, that's an MVP reversal. So like right here, you got apex going up, and what is that date? I can't even. That's today. Anyway, so it's going up, and then boom, pops on around, MVP reversal. We have so many different trades going on every day. This is gold. I wouldn't trade gold today, but flew on up, and then there's an MVP reversal to go short. Okay, this is really messy. It's actually a training slide, but it goes in and it basically shows how there's a lot of trades on here. It's a $1,200 trade, a $700 trade, a $650 trade, $25.60 from 3 trades on the day, and they're MVP reversal trades. We got apex right here. There's an MVP reversal to go short. Okay, so like there was green apexes going up, and then we got a reversal that went short. So this is not even counting for the apex trend trades that are also happening at the same time. Okay, and then we get an MVP reversal. Boom, pops up. So we're going. Now we got 2 short apexes going down. Goes the other direction. That's an MVP reversal. That arrow is flying up. Got green apex, green apex, green apex, green apex. We get a red arrow going short. Now we go short on the trade. So, again, there's a lot of information on there. This slide is actually in our forum under the Elite MVP section. But this was May 1st. So I mean, most of the stuff is most of the stuff I showed you is July. I like to show you current stuff, so it's not like cherry picking and that one day that worked. But this is pretty. I mean, rarely do we get 3 MVP reversals. I'll tell you that right there. It's pretty spectacular, but it's a great training just to show you how it works. Here's some more stuff right here. Let's see. This is June, but it's showing apex is going down. There's an MVP reversal going up, and we can just keep going through them again and again. Now a lot of days are just flat. There's not a whole lot happening, and people can get bored. Some of you like to do counter trend trading. That's what the MVP reversal is. Some of you like to do trend trading. That's what the Apex Elite trade is. Some of you like to do scalping. Okay, or some of you like to, you don't care. Just give me the trade. And let me do all of the above. But momentum scalping is pretty cool. The way that we do it, we go in and use the ATM over on NinjaTrader, and we show you how to set that up if you don't know. But it's an automated trade management built into the DOM or the chart trader. And so you go right over here, and what we do is what we look for is, has volume exceeded expectations? Okay? If volume exceeded expectations for that bar, and that bar closed up, we have a setup buy bar. If volume exceeded expectations, we had a down close, we have a setup for a potential sell entry. So that's now the setup bar, or trigger bar, whatever you want to call it. But right there, the next bar, the bar where the trigger actually gets triggered, the entry bar, if it breaks the high of, guess by what, 3 ticks. Okay, so if it breaks it by 3 ticks, and we just found that to be a very consistent thing, then we'll get in the trade, and we'll take the profit 1 more bar later. Like basically, we're looking at making 11 ticks on the trade. And it's just a scalp over and over and over and over and over again. Where's our stop? Our stop is sort of the low of the bar. Optionally, you can go ahead and move it up 1 more. I found often I like just leaving it here and giving it a little bit of wiggle room, because sometimes it'll just oscillate around and they'll pop up, you'll get out. Some people want to just tighten that up real quick. I'd rather take on the few ticks of risk that are left there, because we're talking about 7 ticks of risk to be able to have that trade be profitable still. But it's green bar, exceeds expectations, buy 3 ticks above, sell 11 ticks higher, set your stop at the bottom of the bar, and repeat, 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 repeat. Okay? Here's the S&P, and this is from today. And you don't have to worry about the MVP lines. You don't have to worry about the apex pattern. You don't have to worry about high to low ranges. You don't have to worry about well, you do look at deviations. Because I look at deviations to go, when it gets to a deviation level, I think it's going to bounce. So look at this one deviation level right here, -1. Watch how it goes down to a deviation, bounces off of it. Goes back to settlement, goes back down to a deviation, bounces off of it. So I probably don't want to be going short right here. I don't care if you're scalping or you're doing trends or whatever. You probably don't want to be going short at a deviation level. But all you need are deviations, and we actually have a chart for it, and you need diagnostic bars and volume. But if you go over and look at this, it's coming down, it's going into the deviation, so we're going to back off, but then it turns around and starts going long. Okay, volume exceeded expectations. Up, close, bar. Enter 3 ticks above the high, put a stop at the low, and take profit, at the close of the next bar. This one right here didn't break by 3 ticks, so we don't have an entry. Okay, now we're starting to go back down. And that's actually good, too, because we're going into a deviation from low to high, right? Because right here, we move down 1 deviation. Right here, we're moving up a deviation. Because if you go down a deviation from settlement and you go back up to settlement, that's a gap fill. It's a deviation move. So right here, we're going down. Volume exceeds expectations. Down, close, bar. Enter 3 ticks below the low. Put a stop right at the high, and then just trail it down. And repeat. Enter again, take profit. Enter again, take profit. Enter again, take profit. Enter again, take profit. Okay, now we're going to do a deviation. Let's stop. Okay, good, we did. And, you may have got that one. That one would have lost if you didn't stop the deviation. So now we're waiting around. Okay, it doesn't break 3 ticks. Goes down into deviation. We're still not doing it. Goes back up. Okay, we're back in. 3 ticks in. Take profit, take profit, take profit. I mean, you're talking 30 trades on this chart. Okay? Maybe not 30. Maybe about 15. So, but plenty of trades. That's the S&P. That's just going in and scalping the S&P. Now, it's not my favorite one to scalp because I don't like how it ticks in quarters. I feel like it's too slow. I prefer things like the Russell, gold, oil, currencies, things like that. I don't like the scalping size just because it's quarters. And it's slow. To me, it moves really slow. But if you like the S&P, great way to check out, potentially scalping it. Just really watch for those deviation levels because they're everything. I mean, you'll literally knock out a ton of losers just by making sure you stop when it's getting right near that plus 1 deviation, minus 1 deviation, or 1 deviation high to low. And then, you can do momentum scalps on futures. You can do them on Forex. You can do them on stock. Probably wouldn't do them on options because the moves probably, unless you were using much larger bars. Like I wouldn't put on call and put options. I wouldn't do them on Nadex spreads. You can do them on Nadex binaries. And if I'm doing momentum scalps, I'm almost always doing out of the monies. If I'm doing on binaries. So I'm usually doing them on futures, but we know a lot of traders that do them. Like John, he's in the room all the time at night and stuff, and when he can be, and he's doing them on binaries, and he uses out of the monies. Sometimes like $10 to make 40, or $100 to make 400. Anyway, so more momentum scalps. I mean, this is a choppy day. Nothing's happening. No apex entries are getting triggered off because, they're all above the line, green line, nothing here, green line. I mean, you got nothing. No reversals, no apexes. But you got momentum scalps right there. You got another momentum scalp right here. You got more momentum scalps going down. You got more momentum scalps going down. You actually back off because the deviation level's coming into place. Got some back up. And, there's a couple losers on that page, but there's a lot more profitable trades than losing trades on that page. And that is from, is that today too? Let's see here. Yeah, that's today. So current charts, massive, major markets. Gold, momentum scalps, momentum scalp. I mean, that was pretty fast. I don't know if you would have got those. Like all those bars, we have this thing called velocity down here. And when it's yellow, that means that bar took less than 1 second to form. Okay? When it's red, when it's yellow, it was unmeasurable. Like it's millisecond. When it was red, it was basically a second. And so a lot of velocity happening. But anyway, so if you were lightning fast, you would have got all those. But you at least could have got these right here that weren't near as fast. And so you got those trades in, You may actually made some nice profit when it took off really fast. You may have actually got, because your take profit, it flew down. And could have got a good, nice order there because the limit is at this price or better. Anyway, so it's flying down, and you can see there's just volume going like crazy. We're approaching the 1 deviation. We're going to back off. It starts bouncing up. Awesome. You definitely could have got these going on back up. Lots and lots of scalps. And, basically one scalp's worth approximately, depending upon the market you're on, about $100. So per trade. And now that chart right there, there's probably 25 plus trades right there on it. We could count them all, but it'd take a while. Oil. This is oil from today as well. That was gold from today. And flying up, momentum scalps, just over and over. You can see it. Every time volume exceeds expectations, bar breaks high by 3 ticks. It doesn't always do this. Like right here. See how it's like? But we're getting a ton of it today. And just flying up. And so, all these are momentum scalps, like all the way up. Take it to about 1 deviation. Back off. Yeah, they won, but probability is a lot lower. Thing turns around. Okay, let's write it back down. Okay, starts popping back up. Let's grab it. All right, let's stop. We're getting close to 1 deviation. Yeah, we missed out on a few, but that's okay. But just gives you some good examples. So, we also talked about the deviation levels already a little bit. How far is the market expected to move? Should I take more entries? All that. We post them on our website for free on different markets. We got ES and crude oil and all this stuff. We actually post them every single day at 8:30. But we also auto-plot them inside NinjaTrader, which is really, really helpful. And, this, for example, this is the Russell. So it's showing, hey, it moved a deviation. And just over and over and over again, you'll see markets, oil, gold moved up 0.5, it moved down 0.5, got a little bit more than 0.5 right there, but it basically gives a very realistic expectation on movement. This would have been wanting to stop adding to your shorts because it's done. It's going flat. There's a lot more I can share with you than this. We got spike strikers, profit poppers. We got what we call boomerang trades. Market goes there, comes back. The spike striker is a volume trade. It shows you how to trade volume spikes. We teach magnet pricing. We have a lot more than this, but these are some of the 3 of the 6 trades that are available just on those charts that we're talking about. And in summary, you want to make sure that you're removing time from the equation. If you want to do trend trading, you want to do scalp trading. You want to do, because scalp, you're going for ticks, you're not going for minutes, okay? So if you want to do scalp trading, trend trading, or reversal trading, you need to, trend reversals, you want to remove time from the equation. You need to simplify your trading to one simple pattern, and you need to be able to filter and define your entries and set stop losses and know exactly how you're going to let your profits run on your trend trades and on your trend reversal trades. And you really need to master the expected volume, expected ranges, and expected moves on a day so you know when to turn off trades. Know when a market's going to be choppy because volume's way below expectations. Know when a market's going to trend so you can take advantage of that when it's way above expectations. You can use this on any market. So I got people that use it on stocks. I got people in Mexico using it on the Mexican Stock Exchange. I got people in Canada using it. I got people in Australia, people in Singapore, London, Netherlands, Switzerland, obviously a lot of traders in the U.S. as well. We got traders in Israel. We got traders all over the world. So whatever market you're looking for, I'd be glad to help you out with on it. And the things that we talk about, I've sort of mentioned these things already, but know the movement of the expectation of the market. Become the guru. That's probably one of the biggest things I can give you. That's something that my mentor taught me. Don't try to follow a guru. Learn from people what you can, but then learn to make your own decisions. Don't look for somebody to spoon feed you trades. Figure out why they make the trades, figure out how to duplicate the trades, and if they're going to call trades, that's great, but see if you can call it before they do. Educate yourself. Professional traders will spend years learning. Think about a doctor. They don't just go out and operate on somebody. Think about, would you want the guys I just want to be a doctor, and I'm just going to wing it. And I haven't really read a whole lot of books on it, but man, I saw one video. It was pretty cool. I'm going to go do it. And let me go ahead and cut into your brain. Not a good idea. Do you want the person who didn't even get in a flight simulator or read the manual or know how the plane works to be the guy who's going to fly you? It's like, man, I just learn when it's real, when it's live, and I just go. And if somebody tells me to go down, I'm going to go down. They tell me to go up, go and go up. I'm just what I'm going to do. No, know what you're doing when you fly. You don't want to fly with anybody else. Well, you wouldn't want to put your life in the hands of that doctor. You don't want to put your life in the hands of that pilot. Don't put your money in the hands of something that you aren't willing to spend a little time learning. We have about 4 to 5 hours of courses, quizzes that go through and teach you stuff. Now, we also have the rooms. We have all that. But if you'll spend 4 to 5 hours going through these courses and knocking it out, and we go through setting up NinjaTrader, activating data feeds, installing the indicators, the ABCs of each one of these little systems. And then dive into that room, get engaged, post charts, ask questions. If you're really wanting to learn how to trade, this is not for somebody who wants to just be spoon-fed, and eat off of a bottle. This is somebody who actually wants to trade, who wants to be a trader, who wants to control their future, who wants to be trading in 12 months and 12 years. If that's you, then Apex is a great place for you. So if you're willing to do that, you can be up and you can be running by Monday. Okay? And we have a special offer on our Apex Elite membership. We have a toolkit with the training resources that automatically installs everything for you. We have trade room access, the Elite Trade Room. We're going to do a webinar tonight at 7 o'clock. Sort of a getting started webinar just to let you know where everything's at, help you get familiar with stuff, because you're going to feel lost probably to begin with, and we want to get rid of that for you so you can focus. Also, we'll have tech support personnel available, so if you have any issues installing anything, we're going to get right on your computer with you and help you take care of it tonight. Additional bonuses that we have binary scanners, spread scanners. We have a lot of information on the Nadex Exchange. We have a trading forum, help desk, hundreds of hours of additional education. And we have webinars every single month. Actually, just about every week we have 2 webinars. One of them is usually about an hour and a half. The other one's somewhere between an hour and a half to 2 hours. And they're on all various topics. So that's just there. That's free all the time. How much is it? The Elite membership is $200 a month. It's $2,400 a year. The webinar promotion is we're actually, instead of $2,400 a year, we're letting you do it for $1,350 a year. But you probably want to try it out first, right? You're like, that sounds good, and I saw those $1,000 trades, and all that sounds great, but... Okay, we have a trial for you. It's $7. Full access for the next 30 days. Why $7? Do we care about $7? No, if you want your $7 back at the end, I'll give it to you. But somebody who's not willing to put down $7 is probably not willing to put in 4 hours of training. Okay? And again, if you want the $7 back, risk-free, at the end of the 30 days, just tell me, I'll give you your $7 back. But it's just looking for people who are actually really interested in trading. That gives you 30 days of uninhibited, 100% pure, full access to everything. Now, some of you on the webinar may have tried our trial before. And so what we're going to do is give you an additional ability to, for $7 more, you can get a 14-day trial. Okay, so it's not trials forever. But a 14-day trial, if you want to come back, you want to try it again. So try it for 30 days. Of course, 14 days for trial members. Try it for 30 days before you pay at all for your full membership. Okay, so we'll hit the card for $7 and we won't touch it again for 30 days. If $1,350 is too much for you, then what we'll do is we'll let you do the exact same deal, $7 for 30 days, or $7 for 14 days if you had a trial before with us, and you can do the monthly membership. Okay? And it actually doesn't matter if you're a new member or any member, but go to apexinvesting.com/TK Traders Kingdom promo. So /TK promo. And if you're an existing member, this is really important, otherwise your toolkit won't work. Okay? If you're an existing member, make sure you log in first. So again, make sure you log in, because if you make a new user ID to try to get like the extra 14 days, it's just going to lock down the toolkit. Okay? So make sure that you do not create a second ID. It will lock down everything. So just log into the website first and then go to apexinvesting.com/TK promo. And again, 30 days for $7. That basically gives you 2 payment cycles. And we have a 4-week plan. You're going to learn and you're going to demo is what we suggest the first 2 weeks. Once you, like that first week, first couple days, you're getting everything set up. And you're spending, the weekend learning. And then you're going to demo trade it over the next 2 weeks to where you're trying to be the guru. You're trying to know the trades before some of the moderators call out occasional trades. And you're not depending upon them. You don't ever want, even from day one, you don't want to be depending upon them. You just want to use them as confirmation. So then, ideally, in the last couple weeks, you're trading live and you pay for that subscription before it becomes due. And that gives you 2 pay cycles to do it. But go ahead and sign up now. And we're gonna have a getting started webinar tonight at 7 o'clock Eastern time. And what we're gonna do is this is actually gonna be good through Monday at midnight. Okay, so it'll be good again through Monday at midnight. And after that, then the promo will be gone. It'll go back to the normal rate, normal trial periods, everything else. And so make sure, ideally, you sign up tonight so you can spend a few hours this weekend studying, and get it going. So the $200 offer is basically always available, just not that full trial like we have right there. And at least I say always, at least right now that's the rate. And but the annual promo, I mean, that's just like right now. So I know summer's a busy time. At the same time, I mean, we're talking, basically, I mean, you're saving over $1,000. And you have 30 days. So summer's going to be over in 30 days, pretty much. It'll be into August, school starting up, all that fun stuff. Spend the next 30 days getting it down. And, get it going. I know that we were going to do a drawing. And so, Bob, can you randomly pick somebody? And that is inside the room. And we'll give them a free year of membership and a one-on-one training session with an Alliance member. See if Bob's there. You know what? I'll randomly pick one. And we'll get you going. Oh, there we go. All right, Ron Risen. Ron Risen, congratulations. Bob will get your information to us. And we'll be happy to help you out. And, the big thing is, I mean, it's a trial. Check it out. Hope you enjoy it. And then it lets you demo trade everything to see what you think before you, move forward. Congratulations, Ron. We'll be in touch with you, and or be in touch with us, okay? And we'll get you going. All right. Well, thank you very much for your time, and we will be. You're welcome. And I'll see y'all in the room here in about an hour and a half. Okay. All right. Thank you.